All right, let's dive in. Ready for a deep dive?
Sounds good.
Today, we're tackling Warren Buffett.
Oh,
We're going deep,
yeah,
using the Warren Buffett Way as our guide.
right?
It's like we're cracking the code of one of the greatest investors.
What's interesting is how Buffett built his track record.
Yeah.
It wasn't about chasing trends or, risky bets.
Right.
He was all about deep analysis,
Okay.
understanding businesses really well, and thinking long term.
So not like some stock market psychic.
Not at all.
Okay.
Buffett is a product of his mentors.
Right.
And the book really highlights that,
Yeah.
starting with Benjamin Graham.
Oh, yeah. The Dean of Financial Analysis.
Exactly.
Yeah, right.
Graham was all about margin of safety.
Okay.
It's not just about finding a good deal. It's about knowing a company's real worth
Right.
and only buying when the market price is significantly lower.
So like a built-in cushion for your investment.
Exactly. Graham's approach was all about minimizing risk,
Mm-hmm.
making sure you're not overpaying, even if your analysis is a bit off.
Interesting. So you're saying even if you're a little wrong,
Yes.
you have room for error.
Correct.
But Buffett, he didn't just stop there.
No, he didn't.
He took inspiration from Philip Fisher,
That's right.
who was all about a company's growth potential.
Right.
And wasn't Fisher kind of known for some unorthodox methods?
Absolutely. Fisher believed in going beyond just the numbers.
Right.
He was a big advocate for this scuttlebutt method,
Okay.
where you gather information from competitors, customers, suppliers, anyone who could give insights into a company's landscape.
So like an investigator for businesses.
Yes, precisely. You're getting the full picture.
Right.
And Fisher's argument was that the more you know, the better you are at assessing long-term prospects.
Okay, so we have Graham, who's all about safety,
Right?
and we have Fisher, who's about growth.
Yes.
Who else influenced Buffett?
Well, the book also talks about John Burr Williams,
Okay.
who focused on dividends.
Dividends. Okay.
He was the pioneer of the dividend discount model,
Okay.
which is a way to value a stock based on its projected future dividends.
So you're looking ahead, not just at the now.
Exactly. You're understanding the trajectory of a business.
Interesting.
Now, the really fascinating thing is that Buffett didn't just follow one guru.
Right.
He synthesized their ideas into his own approach.
He kind of cherry-picked the best.
You could say that.
Oh,
He
yeah.
found what worked for him.
Now, of course, we can't talk about Buffett without talking about Charlie Munger,
You can't.
his business partner, right?
Yeah, a longtime partner.
What does Munger bring to the table?
Munger's impact on Berkshire Hathaway is huge.
Okay.
He brings an incredible ability to understand human psychology
Okay.
and how that affects decisions,
Interesting.
especially investment decisions.
Got it.
He calls it the psychology of misjudgment.
So, like, he keeps Buffett from making emotional decisions.
It's more than that.
Okay.
They both challenge each other's thinking. They're constantly looking for blind spots.
Yeah.
Together, they created a system to avoid common pitfalls.
Okay. That makes sense.
They really complement each other.
Now, when people think of Buffett, they think of Berkshire Hathaway.
Of course.
But it's more than just stocks.
You're right, it's a conglomerate,
Yeah.
owning a bunch of businesses acquired over decades.
Right.
And insurance is a key part of this portfolio.
Insurance. Why insurance?
Insurance companies collect premiums up front,
Yeah.
but they don't pay out claims until later.
Right.
So it creates float,
Full.
money that Berkshire can invest while waiting to cover those claims.
So like free money to invest.
It's a low-cost source of capital.
Okay. Makes sense.
And because Buffett and Munger are such skilled investors,
Yeah.
they've generated impressive returns with this float, really fueling Berkshire's growth.
And Berkshire Hathaway, they own a diverse range of companies.
Absolutely, from See's Candies to Clayton Homes,
Wow, that's a wide route.
McLean Company, and even the Pampered Chef.
The Pampered Chef.
Yes,
Oh, really?
they all represent different aspects of Buffett's investment philosophy.
So kitchenware parties and candy,
Exactly.
all part of the same strategy.
It's fascinating how they all connect back to his core principles.
Okay, so See's Candies.
Yes,
That feels like a classic Buffett pick.
it is.
You got the brand, the loyal customers.
It goes back to what Buffett calls a durable competitive advantage.
Yeah, the moat.
Exactly, a moat.
Okay,
See's has built a reputation for quality and consistency.
right.
They're very resilient to competition.
And people will pay more for that.
They will.
Now, Clayton Homes, that's different.
It.
Manufactured housing, it's had its ups and downs.
This is where management quality is so important.
Okay.
Clayton Homes survived those downturns by avoiding risky lending and prioritizing responsible growth.
So it's not just the industry.
Yeah,
It's about who's running the show.
absolutely.
Makes sense.
For Buffett, it's all about honest, competent leaders.
Got it.
People who prioritize the shareholders.
Then there's McLean Company.
Right.
Huge distribution network.
Massive.
What's the appeal there?
McLean is all about scale and efficiency.
Okay.
They serve convenience stores and restaurants.
Wow.
They're a vital part of the supply chain,
Right,
making
right.
them really hard to compete with.
They have a big moat.
A very wide one.
Okay.
They're essential but not flashy.
So the unsung heroes of the food industry.
You could say that?
And then we have the pampered chef.
Yeah, an interesting one.
Started by a mom entrepreneur with home parties.
It shows Buffett's appreciation for simple but scalable businesses.
Okay. Interesting.
You don't always need a complex approach.
So it's all about that foundation, right?
Exactly.
A solid business, strong leadership, and that moat.
Yeah, that's the basis.
It's amazing how all these businesses tie back to Buffett's philosophy.
It is.
This has been a fascinating overview of his approach.
It is fascinating.
But I'm really curious to get into the specific guidelines he uses.
Yeah, the nitty-gritty.
Yeah, when he's making investment decisions,
Absolutely.
that's where it gets real.
That's where the rubber meets the road.
All right, we'll be back soon to explore those guidelines in part 2 of our deep dive into the Warren Buffett Way. Welcome back to the deep dive.
Great to be back.
In part 1, we covered the foundation of Warren Buffett's approach.
We talked about his mentors, his philosophy.
Yeah, all the things that shaped him.
Right.
Now we're getting into the specifics.
The nitty-gritty.
Yeah, using the Warren Buffett Way as our guide.
Exactly.
We're going to break down those guidelines he uses when evaluating investments.
It's like a toolkit
Yeah.
for navigating the market.
Okay, so what's in this toolkit?
Well, the book breaks it down into 4 areas.
Okay.
Business tenets, management tenets, financial tenets, and value tenets.
Okay, 4 areas. That makes sense.
Each one focusing on a different aspect of an investment.
All right, let's start with the business tenets.
Okay, sounds good.
What does Buffett look for at the most basic level?
First and foremost, understanding.
Understanding, okay.
He only invests in businesses he can grasp,
Makes sense.
companies with clear, predictable operations.
So no crazy complex stuff.
Not necessarily. It's more about being able to understand how the business makes money.
Right, being able to wrap your head around it.
Exactly.
Okay, what else?
A consistent operating history.
Okay, meaning?
He wants to see a track record of profitability.
Okay, so not just a good year here or there.
No, it has to be consistent over time.
Right, it's got to be able to weather the storms.
Exactly. And that ties into the idea of moats.
The moats, we talked about that a little bit with C's Candies.
Right.
Can you explain that a bit more?
So a moat is any factor that protects a company from competition.
Okay, like a barrier to entry.
Exactly. It could be a strong brand, a unique product, a cost advantage, even regulatory barriers.
So the wider the moat,
The better.
the more sustainable the business.
Precisely. Buffett believes those companies with wide moats are more likely to maintain their profitability over the long term.
Makes sense, so it's like a built-in defense system.
Exactly.
All right, let's move on to the management tenets.
Okay, the people running the show.
You mentioned before how important management is to Buffett.
It's crucial.
What specifically does he look for in a leader?
Honesty, competence, putting shareholder interests first.
Okay, ethical and capable.
Absolutely. He wants rational decision makers.
Right.
People who are transparent and avoid the institutional imperative.
The institutional imperative, what's that?
It's this tendency to blindly follow industry trends.
Okay, so like groupthink.
Yeah, kind of, where
Yeah.
companies make decisions that benefit management,
Right.
but not necessarily the shareholders.
So he wants leaders who think for themselves.
Yeah, people who will challenge the status quo.
And act in the best interest of the company.
And the owners.
Okay, that makes sense.
He also looks for managers who are good at allocating capital,
Capital allocation.
knowing when to reinvest profits, when to return capital to shareholders, and when to make acquisitions.
Right, finding that balance.
That's a crucial skill.
Okay, so we've got the business itself, the people running it.
Right, the foundation and the leadership.
Now let's get into the numbers.
The financial tenets.
What are those all about?
Buffett looks beyond the surface of reported earnings.
Meaning?
He wants to see the true profitability.
Okay, how does he do that?
He uses a concept called owner earnings.
Owner earnings, what is that?
It measures the cash flow a company generates that could be distributed to owners
Wait.
without harming the business.
So the real cash flow.
Right, not just what's manipulated on paper.
So it's a more realistic picture of the company's financial health.
Exactly.
What else does he consider?
Return on equity, or ROE.
ROE.
It shows how efficiently a company uses its capital to generate profit.
Right. Making the most of their resources.
And he also looks at debt.
Debt. Okay.
He prefers companies that can fund their growth internally.
So not relying too much on borrowed money.
Right. Too much debt can make a company vulnerable.
Okay, that makes sense.
He wants to see a solid financial foundation.
All right, so we've covered the business, the management, the financials.
The building blocks?
But I'm guessing the most important part for Buffett is the price.
It's a key piece of the puzzle.
That brings us to the value tenets, right?
Exactly.
We talked about buying below intrinsic value.
The margin of safety.
But let's dig into how he actually figures that out.
It's not an exact science.
Of course not.
But he uses a variety of methods.
Like what?
Discounted cash flow analysis.
Okay, what is that?
It involves projecting a company's future earnings.
Okay, so looking into the future.
And then discounting them back to the present.
So like a financial time machine.
In a way, you're trying to figure out what those future earnings are worth today.
Makes sense.
It's about making reasonable estimates based on research.
And once he has that intrinsic value,
he compares it to the current stock price.
Looking for that discount.
That margin of safety.
The bigger the discount, the better the deal.
Exactly. The more attractive the investment becomes.
But finding those deals can't be easy.
It takes patience, discipline, and a lot of research.
Buffett's known for his patience, right?
Absolutely. He's willing to wait for the right opportunity.
Not jumping on every hot stock.
No, he's very deliberate.
He's playing the long game.
Exactly. Building a portfolio of high-quality businesses bought at a discount.
And letting them grow over time.
Right. Ignoring the short-term noise.
This has been a great breakdown of his guidelines.
A lot to digest.
It's clear he's got a systematic approach.
Very methodical.
But there's one more concept I want to explore. Focus investing.
An interesting one.
It seems to go against the idea of diversification.
It does challenge conventional wisdom.
Yeah, spreading your bets.
But Buffett has a different take on it.
Okay, we'll be back in part 3 to unpack this idea of focus investing.
And explore why less can be more when it comes to building a portfolio.
We're back for the final part of our deep dive into the Warren Buffett way.
Ready to wrap things up.
In parts 1 and 2, we covered a lot of ground.
The foundation, the guidelines, the philosophy.
Yeah, all the building blocks of Buffett's approach.
Right, a lot to unpack.
But now I want to dig into this concept of focus investing.
Okay, the idea of concentrating your holdings.
Instead of spreading yourself thin.
Exactly, challenging the idea of diversification.
Which is what a lot of people think is the golden rule.
The conventional wisdom.
Right, so why does Buffett advocate for putting so much into a few companies?
It comes down to conviction and knowledge.
Okay, so you're saying if you've done your homework.
Right, and you've found those exceptional companies.
Ones with those moats we talked about.
Exactly, those durable competitive advantages.
Then concentrating your investments allows you to really benefit from their growth.
You're not diluting your returns by spreading yourself too thin.
So instead of owning a tiny piece of 100 companies,
you own a meaningful chunk of a few great ones.
Okay, that makes sense.
Buffett believes that too much diversification prevents you from really understanding each company.
Right, you can't be an expert on everything.
And it limits your ability to take advantage of opportunities.
But doesn't that increase risk?
There's always risk in investing.
Of course.
But by carefully choosing those companies with strong fundamentals,
right, those proven winners,
you're mitigating that risk.
So it's about quality over quantity.
Precisely. A concentrated portfolio of great businesses could actually be less risky than a diversified portfolio of mediocre ones.
Okay. I could see that.
You're putting your faith in the best.
And if you truly believe in a company, spreading your investment around might actually hurt your returns.
Exactly. You're diluting your potential gains.
Focus investing, it's not just about conviction, though.
No, it also has practical advantages.
Like
lower transaction costs.
Okay, because you're making fewer trades.
Exactly. And those fees can really add up over time.
Eating into your profits.
Right. With focus investing, you keep more of what you earn.
And there's a tax advantage too, right?
Absolutely. Long-term investments defer capital gains taxes.
So your money can grow more effectively.
That's the power of compounding.
But this approach seems like it takes a certain kind of investor.
It does require confidence in your analysis.
Yeah, and a willingness to do the research.
You have to be able to ride out those market fluctuations.
Not panic when things get bumpy.
It's about having a long-term vision.
And tuning out the noise.
Exactly, focusing on the fundamentals.
Okay, before we wrap up,
Yeah.
there's one more piece of the puzzle I want to touch on.
What's that?
The psychology of money.
Ah, yes, the human element.
We talked about this briefly with Charlie Munger.
How our emotions can influence our decisions.
Right. Why is that so important in investing?
Because fear and greed can cloud our judgment.
Make us do irrational things.
Exactly. Buffett and Munger have always stressed the importance of recognizing these biases.
Okay, so it's not just about the numbers.
No, it's about understanding ourselves as investors.
Right, how we react to the market.
And learning to control those emotional responses.
So what are some of these biases?
Well, there's overconfidence.
Thinking we're smarter than the market.
Right. Overestimating our abilities.
Which can lead to taking on too much risk.
Exactly. Then there's loss aversion.
The fear of losing money.
More than the pleasure of gaining it.
Right. That can make us hold on to losing investments for too long.
Or sell winners too early.
Trying to avoid that pain of a loss.
It's a powerful emotion.
So recognizing these biases is the first step to avoiding mistakes.
Absolutely. It's about being aware of our own tendencies.
Are there other biases we should be aware of?
There's anchoring bias.
Okay.
Where we fixate on a piece of information, even if it's no longer relevant.
Like a stock price from a year ago.
Right. And mental accounting.
What's that?
Where we treat money differently depending on where it came from.
So like lottery winnings versus your paycheck.
Exactly. All these biases can distort our thinking.
And lead to bad decisions.
That's why understanding the psychology of money is so crucial.
Wow, this has been an incredible journey.
A deep dive into the mind of a master.
It's clear Buffett's success isn't about some magic formula.
No, it's about principles, patience, and discipline.
And a deep understanding of business.
And of ourselves.
So what's the one big takeaway for our listeners?
Be patient, do your research, and invest in what you understand.
Simple but powerful advice.
Don't get caught up in the hype. Focus on the long term.
And build a portfolio of companies you believe in.
Companies that can stand the test of time.
Fantastic advice. Thanks for joining us on this deep dive into the Warren Buffett way.
It's been a pleasure.
Remember, investing is a marathon, not a sprint.
Stay focused, stay patient, and keep learning.
We'll see you next time for another fascinating exploration.